Right, hello and welcome everybody to another Pepperstone Learn It Live webinar series. Today we're going to be discussing a trader's guide to scalping the markets in 2021. 2020 was certainly a year for the books, and of course I'm sure many of us are glad to be done with it almost now, but 2021 is shaping up to be the year of possibly some pretty big trends and definitely some very big opportunities for scalpers, day traders, and I think swing traders. My name's Thomas Atkinson from FX Evolution. As always, I'm joined by Tyrone Abella. How are you, Tyrone?
Good. Hello, everyone. Welcome to the last Pepperstone webinar of the year. So, yeah, it's certainly been a big year, one we won't forget. But, look, I guess the one fantastic thing about trading is it gave us a lot of opportunities, even though it was a tumultuous year on so many levels. The trading opportunities were fantastic, and I think we're going to get some really good opportunities moving forward, especially in the early part of 2021. So looking forward to get into this webinar and actually sorting out some of these key concepts that we'll be looking for.
Yeah, so we're going to go through in today's webinar quite a few things. We'll get to that in just a moment, but just quickly a risk warning. So obviously the information contained in this video or webinar is generic in nature and for educational purposes only. The information does not take into account your personal objectives, financial situation, or needs. And this information is not to be construed as an offer, recommendation, or solicitation to buy, sell, or participate in any particular trading market. So just a quick thing that we've been talking about all year, Ty, we'll put this back in the chat room right now. There's two great rooms and two great areas that we definitely recommend for traders out there and to go and have a look at, and that is the Pepperstone Telegram group, which you can find on the link here. We'll also post that in the room, and also our Discord community. So that's another one of those. The Discord community is more about having a chat with other traders, and of course the Pepperstone one is more about getting snippets of information, very important information, at your fingertips as fast as possible. And they've got some great things such as like the top kind of bits of news for the day. If we have a look at what we're going to be covering in this session, we're going to be looking at scalping and day trading strategies. We're going to be talking about really breaking down how we would approach a situation. We're going to be using our top-down approach to a degree as well, but we'll actually break down all the different things that we think about and kind of the nuances behind scalping and the way that we approach it and the way we're going to approach it for 2021. We're taking a look at some live chart and price action analysis to do that, which I think is going to be really interesting, and I definitely encourage everyone to stay tuned throughout today's session to find out more about that, because I think it's one of our biggest in-depth breakdowns, and also key markets and themes to keep an eye on for 2021. So what do we think is going to be kind of the big stories of 2021, and what do we think that really means for us as scalpers and day traders? Do we need to be concerned? Do we need to be worried? Do we need to think, oh my goodness, there's going to be a very large move like there was in March this year? Well, we'll talk about that throughout today's session. And then, of course, live Q&A. So please, if you have questions, ask them throughout the session. We will answer some on the fly, and we'll certainly get to them at the end and answer as many as we can. So some of our key market themes for 2021, Tyrone. So I think one of them is going to be US dollar. Now, anyone that's trading the markets right now will have seen that the US dollar broke a key level of support a few weeks ago. We've spoken about that quite a lot throughout these webinars, that 92 zone on the US dollar index. And ever since then, it's really been in pretty strong short mode. So it's been selling off quite aggressively. Now, Tyrone, into this webinar today, we have seen some big sell-offs in the US dollar. Now, this is because the Federal Reserve FOMC statement is coming out very soon. We'll talk about that. But the price of the US dollar, I think, is going to be key for currency traders, key for commodity traders, and possibly even key for index traders around the world. Ty, how important is the US dollar over the next year?
Yeah, look, the dollar index, especially in the last, probably 2 hours, just absolutely fallen off a cliff, which is really, really interesting. So it's going to be very, very impactful on a lot of the majors that we look at. Obviously, it's one of the main focuses, especially I think leading. I mean, when we look at 2021, we're not talking about the whole 12-month period. Of course, we're talking about the start of the year and probably well into it. I think that's probably all we can predict as I guess traders and investors at that point. But I think that gives the market a lot of time to really find its feet and actually get moving. Like we've been talking for a while now that the dollar is probably going to fall to somewhere around that sort of 88, and that's going to be it's going to have significant impact on things like the euro and even the dollar-based pairs. So when you see that sort of thing happening, we're going to see the establishment of some very big trends. What we have seen is the markets, all the major dollar-based bears have gravitated to very, very key zones in recent weeks. And whether the catalyst for that has been the election result, the price of oil, whatever it is, it's forced these key zones to get broken. Now, the euro has broken out of a key zone. It's made a high that it hasn't done in nearly 3.5 years. The Aussie dollar is the same. The CAD is falling. The Swissy is falling. All these things are really setting themselves up for some really good trend action early in 2021. I think that's probably what we're going to focus on, what's going to happen in the first few months of the new year, because it's going to give us not only opportunities to actually join an existing trend, but just as importantly, probably scalp those moves inside that trend. So it really gives you a two-pronged attack on how you can actually attack the trading environment by going with the trend, which is what we always want to do, but just as importantly, scalping those really good opportunities that lie inside the trend. The beauty of knowing where a trend is going, of course, is being able to scalp in that direction. So we'll certainly touch on that tonight.
So Tyrone, really, I guess on this slide, price of US dollar is going to be a big concern. FOMC, the Fed, central banks, central bank policies across the world, now that we're in monetary policy almost everywhere in the Western nations anyway, is going to be key to how you make decisions on the longer timeframes. But we're scalpers potentially, or day traders. Do we need to care about those things? And I would argue, yes, we do, specifically when key technical analysis levels are broken. Tyrone mentioned before, there's a bit of a target or a longer term kind of movement here that could happen on the US dollar. We'll take a look at that in the live charts. But really, this is because central bank policy pushes things in that direction. Now, this is actually Thursday, December 17th here in Australia. In the morning, you'll notice FOMC statement. Notice that the US dollar is also moving into this statement event. We've got economic projections, the press conference coming out, all of this red news here, which you can get online by looking up economic calendars. I believe Pepperstone also has one on their website. So all of this information is incredibly key for us to know. And this is one of those days where, wow, there's going to be some pretty big fireworks in terms of volatility come through. In 2021, expect things like the FOMC statements, like central bank policies to remain one of the most important bits of news, and actually for them to be the main driver. Usually it's been CPI or little bits of information over time stacking together. Now we're looking at how is the central bank navigating these current crisis period times? How are they going to get out of potential recession and into, of course, growth? So which trading pairs are going to be best in 2021? Well, we still think gold, silver, all of those major kind of commodities are going to be very interesting. Silver has properties as well that are used in things like recoveries. So copper is another one of those. Silver and copper are used heavily in building and infrastructure projects. They therefore have that demand. We've seen movement into cryptocurrencies as well recently in gold, maybe some hedging going on in the markets. And then of course, our major currencies such as US dollar are going to be very, very important. A few people mentioning here plus stimulus as well, absolutely. So monetary policy, stimulus, etc., all very important. So for 2021, we're going to need to see what are we going to be doing? Are we going to be part-time traders with the goal of eventually becoming full-time traders? That's the main goal for most people, isn't it, Tyrone?
It is, and it's a great goal to have. But I guess the key to it is actually making sure that your journey to achieve that is actually structured in a way that you don't put yourself under pressure. So, scalping is one of the most popular ways for people to get into the markets. There's no question about that. Pretty much, as soon as someone enters the market, what they want to do is scalp. We see it all the time. Unfortunately, it's one of the easiest things to do. It's one of the hardest things to do all at the same time, because the problem with scalping is it requires certainly a lot of discipline. Okay, it probably requires even more discipline, you'd argue, than actually just following a trend and buying and holding long, because that doesn't involve looking at the charts all day every day and making decisions on the fly. When you go into scalping mode, you've got to make quick decisions, but you've really got to have a good understanding of what the market's actually doing. So although it is easy in that regard when you know what the market is trending and what direction it's going in, scalping can be a really easy thing to do. If you don't understand those basics, really, scalping can be extraordinarily difficult, especially if you haven't got the discipline to follow through or you haven't learned that discipline yet. So I think for people who are looking at, either moving into a part-time mode or they're still learning the craft, just be mindful that when you are looking at scalping as your first foray into trading, if you like, you are entering a realm that, requires probably more knowledge and more discipline than you would probably otherwise think. I know it looks, relatively easy where you think you jump in and jump out. You can only be wrong half the time, right? That's what everybody thinks. But it doesn't quite work that way, does it, Thomas? Not by any stretch of the imagination.
No, that's right, Ty. So I think some of the things that we're going to be setting up for 2021, and I just want to say this is like a year ahead style playbook, is that if I'm going to be a scalper and I've decided I want to day trade or I want to scalp, let's say, you're going to have to dedicate certain periods of time. Now, those times are going to generally be around market session opens, and you're going to want to be targeting moves within those sessions. Now, that means that you must be disciplined with the amount of time that you put in, and you must be consistent in that. Most traders, we lose that consistency. And I know that's a boring thing to say. I'm saying at the start of this webinar because we want to get into the live market analysis and go through the approach, but it's something that's so essential. People tend to go really, really hot for 2, 3, 4, 5 weeks, kind of like when you get back into the gym, you get motivated, and then 2 months later you give up on it, and then you go back to it 6 months later after that. And I find with a lot of scalpers, that's the approach. It's major. It's probably a major problem, really. But
are you speaking from experience there, Thomas, in regards to the gym?
Well, no, never tie. No.
I think Corona got everybody in that regard. I think Corona had a bit of more influence on the gym than it probably did in trading circles, to be honest.
Hey, I lived in Melbourne, and I'm sure many other Melbourne people are visiting today and listening today. But we were locked down in the CBD here, Ty, and didn't have the freedom of the slight countryside we were in. But the point is that discipline is the key, and sticking to your plan. If your plan is to be a scalper, maybe you select Tuesday, Wednesday, or Tuesday, Wednesday, Thursday being the days that you're going to put in the work. Put in the work. You have to put in the work. If you're going to be a swing trader and you're part-time, it actually requires less work in front of the charts, but you need to understand you've got to put in the work. Very, very tough. So it's one of those things that we think that you need to make sure that you can dedicate that time. If you can, then obviously you can have some success there. But if you can't, possibly swing trading or day trading may be better solutions.
I think it's the instant gratification that scalping gives people, that they can get in and out of a trade very, very quickly. So they think they're limiting their risk in a sense because they're not exposed to the market over a longer period of time. And look, as much as that can be true if you know what you're doing, it can also work against you, because when you're trading a volatile market, obviously, it can go against you very, very quickly. And if you haven't got the experience or discipline to be able to handle those sharp moves, you're going to find yourself potentially making, silly little mistakes, like trying to double down or trying to, work out that market can't go any further. We'll give you a tip. The market can go as far as it needs to go, and don't ever think that it can't do something, because that's when it'll bring you undone. So I guess if you got, our first little tip of advice for 2021 would be that if you are starting out, or if you are looking at taking your trading to the next level, try and approach 2021 with a different mindset if it hasn't been positive for you in the past. If you've been struggling a little bit in the past, trying to get your consistency right, look for the longer term moves first rather than going straight into scalping. I think it's probably the best advice that we can give you there, because scalping becomes a hell of a lot easier when you understand what the bigger time frames are doing. We can't emphasize that enough.
Look, we do talk about the top-down approach quite a lot, Tyrone, but I want to emphasize it with the US dollar right now. So the US dollar 92, if you put this on your chart and you looked at 92 and you blew it out to a weekly or a monthly, what you're going to notice is there's a huge amount of market structure or support or price action around this zone. And that when it broke this zone and closed below 92 last time, it had a tendency to fall right down to the 89, 88 area. Now, what we've seen is that the market came down to that zone, respected it, bounced, came down, tested it, and then of course on a significant time frame like a weekly here and a daily, it closed below this area. That was the signal that money flow or movement of cash is going out of US dollar and into potentially what we call risk on, which could be throughout things like possibly you've got things like cryptocurrencies, you've got obviously indices, all sorts of other kind of investments. So when you've got risk on, you do usually see a declining US dollar. It's also been in the best interest of the central bank, being the Fed and everybody else in America, and including stimulus, to potentially drop the US dollar. It's like a race to the bottom. This is not unknown phenomenon, but if you're a technical analyst and you're scalping and you see a 92 break and it closes on a significant time frame, what that's going to do is it's going to allow us to then get a bias in a direction. Now, as all of you would know, if we have a bias in the direction and we know that big money flow is going in an area and towards a zone, if we sold for the last couple of weeks US dollar in terms of US dollar index, we would have done well. Now, what would that have meant? We could have bought the odd versus the US dollar, we could have bought the euro versus the US dollar, could have bought the pound, could have sold the US dollar CAD, all sorts of things. And we would have a bias. And then we can bring that bias into our smaller time frame analysis. Now you'll notice here, yesterday, daily did not close. The other day, 2 days ago, daily was not closing underneath these spikes, underneath these wicks here. Then it did close, and that's sent a huge amount of shorting into the FOMC statement. The point is, though, that all of this time you would have had a short bias, and you would have done better selling the market than buying the market over this period. And understanding that money flow is what you want to do first. Then we can break it down into understanding the currency pair. So let's go to the odd US dollar just quickly here and just bring up a 4-hour. So we've been, let's say, bullish on this pair for quite some time because we like what's happening on the larger time frames. Notice here we've got moving averages, Tyron. We use these moving averages all the time. And this is what we call the 1-2 approach. And really that is that we've had one support touch of this blue line, the 50 exponential. We've had 2 touches of this support line, the 50 exponential. And then every single touch since that point has actually acted as support. Now you can see here that the trend has escalated and become very hyper recently. But this, after the 1-2, plus the price action breaking through here, plus everything else that we've been seeing with the US dollar, could give us a bias towards, let's look at just long on the odd US dollar for the time being. Would you have done better in your scalps over that period? I would say it's arguable always, but I would probably want to be going long than short. Ty, your thoughts on that one?
I think, well, most definitely. And I think the biggest thing that can come out of it, and I know a lot of people say, well, if you're going for short moves, it doesn't really matter. Well, what going with the trend does for you is it's very, very forgiving on your entry point, okay? Because even if your entry point isn't as sharp as it should be, so sometimes that can be for a manner of reasons. It means, yeah, you could have gone onto the charts a bit too late and sort of jumped in anyway, or yeah, your level was just a little bit, just a little bit off. When you're going in the direction of the trend, the momentum of the trend will generally get you out of trouble. So, and what that means is that, you can enter slightly, incorrectly, not be as sharp as you can be, but the momentum will eventually continue on in the direction that you're going, and it will pick you up and carry you, okay? Whereas when you're trading against the trend and you're trying to scalp, if you're not like a scalpel entry, like a surgeon effectively, and you get it wrong, the momentum will shift against you the other way. So the momentum will continue in an upward direction, like it did here on the Aussie, say, for instance. And if you're trying to short that and you are off even just by a little bit on your entry point because you weren't quite as sharp as you needed to be, the market's going to turn around on you, and the momentum is going to work against you and take your stop out. So that's the difference. And that's why, in a sense, scalping in the wrong hands can be quite troublesome, because realistically, if you don't know which way the trend is going, you don't know whether you're trading in the direction of the trend or not. So, and that's where the problems are going to lie. Your stop losses are going to get taken out a lot earlier if you're not really sharp on your entry point. Whereas trading in the direction of the trend is going to give you a lot more leniency in that way. So lesson number 2 for 2021, trade with the trend whenever possible, whether you're scalping or swinging.
Got a question coming in here from Mark Ty, and I think it's a really good question. So let's say Well, the question here is, do you scale in and out? So yes, you certainly could. You can also project better entry points. So what that means is, let's say we've done the 1-2 analysis, we've seen the break of this key resistance, we've identified that on the 4-hour. Okay, well, yeah, we want to trade maybe a 5-minute chart or something like that. We may not want to trade these larger timeframes. But what overall we can then do is we can say, okay, well, every one of these 50 exponentials, we're interested in dialing down into the smaller timeframes. We've recognized on the 4-hour, what's happening on the 5-minute, what's happening on the 15-minute. Can we find an entrance there with a tight stop loss at around a key level? If we can, and it meets our rules and everything we want, well, we've just entered a trend on a 4-hour time frame with significant potential opportunity. We can then pick up positions throughout this in the movement up. So maybe our first take profit for our scalp might be, okay, we want it up to these highs. But we could also say when it breaks through those, we know that this was signaling a test of the previous peak. So we can also take profit at the previous peak. Because remember, we've done our analysis here on the weekly, daily, 4-hour, and then we've gone into the 5-minute and 15-minute for our opportunities, for our little patterns and our other reasons to possibly be in the trade. So I think, yes, you can definitely scale in and scale out. There's no problem with doing that. Traditionally, scalpers don't scale in that much because the idea of a scalp is you're in there and you're out of it possibly in minutes, if not an hour. Maybe you hold it for a couple of hours. Now, where we like to differ from that is we say, okay, what if you were able to get a scalpel-like entry because of your top-down analysis, but you were also able to say, okay, I can predict that it's going to go to this direction, more likely than not, I'm following trend, and then I can actually scale in as I see pullback. So maybe you're targeting this area, you could go down into the smaller timeframes and possibly notice a reoccurring thing in that trend. Like over here, I bet you it was hitting a lower moving average that was certainly providing opportunity. Sometimes you might have a movement past resistance where it just goes crazy movement up. What's that going to be doing? It's going to be hovering and probably testing a 20 exponential moving average on some time frame. Possibly it's the 5-minute, possibly it's the 15-minute. Each time it comes down to that moving average, just like this 4-hour, it's acting as dynamic support. Really, really excellent question. Definitely something that we do. So we're going to break down some concepts. And one of those concepts is going to be, straight away, Tyron mentioned it, 2021, the year of new trends. And what that means is that this year we've had a V-like shape recovery. We look at something like the NASDAQ, or we look at something like the S&P 500, and we had some massive sell-off, then we had a massive return, and the S&P 500 is not as, of course, pronounced as the NASDAQ, but let's say it's up here right now in terms of V-shape. So now we expect further trends and then further pullback trends. When eventually a pullback happens on something like this, it may actually trend down for a little period of time rather than being as aggressive as it has been. We might see some longer based trends. We also may see US dollar even start to strengthen throughout 2021. It's also a possibility. So I think there's going to be good trends, and they're going to last for, what would you say, Ty? Maybe 1 to 3 months, I think, is something that we're going to be looking at. Good for day trading, scalping, and a little bit of swing trading.
Yeah, I mean, look, they could definitely run into March, April, May of next year. I mean, we don't really like to forecast much past 4 to 6 months because a lot can change in that time. But really, that gives established trends a really good chance to play out and reach some really critical zones. What we don't want, look, in a market, even in a volatile market, what we don't want to see is explosive moves that look uncontrollable. What we want to see is basically a series of higher highs and higher lows, and a market moving in an orderly fashion. When a market's moving in an orderly fashion, it allows us to get involved at really good levels, but it also allows us to predict its next move a little bit more easily. When a market shoots up and just shoots for the stars, quite often they can be difficult markets to trade because the pullbacks can be quite aggressive, and yeah, really it makes it entry and re-entering that trade quite difficult. Whereas when a market's moving in a very orderly fashion, it's making a series of higher highs and higher lows, 2 steps forward, 1 step back. It gives you really clear and concise entry points to join the trend. So We don't want to see, a lot of people really like volatile markets, and they want to see, big like news events where markets are shooting hundreds and hundreds of pips each way on every hourly candle. That's not an ideal market environment for us. Traders who, really do this for a living want order. And order means, 2 steps forward, 1 step back, no matter what direction the market's going, because that enables you to get involved safely, efficiently, and you're able to really capitalize on those moves and predict with a fair amount of accuracy the next take profit, but just as importantly, where your stop losses are going to be.
So I want to just quickly talk about this euro tie, because obviously we're getting a bit of a breakout to and close above the current 121.72 kind of area resistance. So we had some coiling coming into that. That's often what happens before a break. Now we do have big news, and that's going to be a concern for scalpers. If you're not concerned about FOMC statement and you're in a 5-minute chart, you probably need to relook at the way you look around news kind of events, because of course they can move very, very heavily. But I just want to point out something here. Here's a 1 hour, and you can see again the 1, the 2, and then the 3rd touch, and even the 4th touch become very good opportunities. Now, one of the things I will give you a hint for is that if we don't make a new peak, so say in a moving average, if you're just going to use moving averages coming back, look for potentially hammers, engulfing candles, all sorts of things like that. Let's say you've targeted the 1, you've targeted the 2, and then you're targeting the 3 now. So you've recognized these, and now you want to go for the 3rd and the 4th. If the market fails to make a new peak, and this goes for a 15-minute, a 5-minute chart, doesn't matter, it fails to make a new high and close above the previous peak over here, do we think that that is a strong market that we should be rebuying on the moving average? I would say no. What you want to be doing is you want to be watching that one, like 2 steps forward, 1 step back, 2 steps forward, 1 step back, but always moving forward in the direction of trend, as Tyrone mentioned. We don't want it to be coming back. So one of the things that a lot of people don't do with this is obviously it's nuance. It's the 1-2 is one option. That's recognizing something that's statistically starting to become likely and may occur again. Then the 3rd, the 4th, the 5th, we don't know how long that's going to go for. But what we do know is that the market should continue that 2 steps forward, 1 step back approach. And when that happens, then we know that the market is healthy and it is in a good trend, and we can continue to follow it that way. So we had that question about scaling in and scaling out. Possibly you enter off the 3rd position, then you enter again off the next touch, then you do so forth and so forth. And basically you might say, okay, well, we've failed here to make a new high, we've come down, and it knocks out both your orders here. That's a legitimate style of strategy for scalping or day trading. It's incredibly basic, and there's more that you can bring into that. And I guess that would bring us to a point as well, Tyrone, that we might share. We do have some really great cheat sheets that we've made throughout the years on divergences, different types of divergences, different types of candles as well. And all these kind of cheat sheets that you can put on your wall, or you can just have them on your computer screen or anything like that, and just be able to easily recognize other reasons to be in trades. And we'll post a link in the chat right now if you're interested in getting hold of those. You can definitely just sign up. It's completely free, so you can definitely consider that out. But basically, you want to have usually around 2 to 3, and I would say most likely 3 to 4 separate reasons to be in a trade. Trend is only one of them. You then need reoccurring things that you know are successful: engulfing candles, hammers or shooting stars, divergences, even some indicators. All of those types of things will help you to become a better trader. So right now we notice here on the euro that the market has broken and closed above on the 1 hour. Okay, cool. Well, that looks pretty awesome. It's clearly broken a key zone. Now we have a few things that we can make a selection for here. We can say, well, we don't like it, now it's up here, but maybe we can target and set an alert for a retest to the previous resistance. We have 3 touches to this zone. We've got 1 touch, 2 touches, 3 touches. So we are now on a 1 hour chart. We notice the market coiled there. The market broke out and closed above. It's showing us that it has bullish intentions. If it does come back down to this zone, would there possibly be an opportunity on the 5-minute or 15-minute for us? Potentially there would be. We could also look at the movement of how it's moved so far in this last movement from a Fibonacci perspective. is there a 38.2 Fibonacci around this previous resistance? A very common thing to occur. Another form of support that could be found in the markets, and you can see it's right around there. So we could then box up a structure, box a level that we're interested in, set alerts for our box level, and then only when that alert is hit, and this is bringing me to my point, only when that alert is hit, come back into the charts and have a look. The problem with scalping and the problem with day trading is that we're required to be on our screens all the time. But if you set an alert that then sends maybe a text message to you or an email or whatever that may be, and it pushes it to your phone, then you can come back when it hits the top of your box, because remember, box structuring is one of the best things you can do, creating an area or a zone that you're interested in, and then you can start to deep dive into the markets. Tyron, what are your thoughts about setting alerts as a scalper? Do you think that, especially with the box structure, not a specific price, but a box, like an area that you're interested in, you make it a little bit higher, so then you can come in and make some better informed decisions during 2021?
Yeah, I think that strategy does work well. And what it also gives you a chance to do is actually reassess the market at that point. Because it's one thing to say, well, if it gets to this level, I'm just going to buy. But, how does it actually get there? What's it doing when it does get there? You can't really foresee that until it's actually there, and you can actually monitor the price action as it's happening. So when you set a box structure as an alert, you get a chance to go back and actually just make sure, double check all of the reasons why you're actually wanting to get into that trade in the first place. Is the market behaving? Is the market doing what you wanted to do to actually enter the trade that you wanted to enter in the first place? And that's really, really important. And by that, I mean, if you set an alert for, look, the euro is a perfect example, right? Like, let's just say you wanted to go long on the euro at 122.15, right? Nearly at the high that it reached there. And if it gets to that level, I'm just going to go in. I think that's going to keep going there from that point. Now, if you look at that in that one-dimensional way, right, it's going to approach the 122.15 area one of two ways. One, in an out of control candle that just happened, that broke out of a key zone, or it's going to get up there in an orderly fashion. Now, which one are we going to want to trade? Are we going to want to trade the big, fast, impulsive move that could do anything from here? Or are we going to look at the one where it's making a series of higher highs and higher lows, making good progression, momentum is definitely on your side, and you're getting a nice pullback level? That's what I'm talking about, and that's what Thomas means by setting a zone there, because if this alert went off at 122.15, I don't know if I'd be jumping on board after one big long candle like that. I'd be waiting for the pullback. And if you just do an automatic entry because that's what's happened, then you could be basically succumbing to what's happening now, and that sharp pullback might happen all the way. It could go back all the way to the zone in which you probably want to be buying, which is when it comes back and tests that new resistance.
And what's going to happen to our scalp during that time, Ty?
It's that scalp. If you entered that aggressive scalp, you're gone.
Exactly. Yep. Your stop loss is taken out. A lot of people, yep. We're talking about entries right now, but the other reason that you might want to target a zone of pullback or a box area that you're interested in is that you can then use the orderly kind of technical analysis of the market, the normal move, where it might have a 20 moving average at the same point, again on a 4 hour or 1 hour or whatever it might be. And all of these larger time frame analysis things are going to help to support your scalp, because ideally, why are we getting into scalping? We want to make 5, 10, 20, 30 pips with really tight stop losses. Now, the problem is really tight stop losses at the wrong zone are going to get you stopped out 10, 20, 30 times in a row. You don't want to be like that. And you also don't want to be just constantly coin flipping, because you want to scale your business. You want to scale your risk. So the reason why we use top-down approach and we're saying, okay, if you target better areas, that might work out for you. It's because when you target better areas, or you target areas that are through multi-time frame supports and resistances, you give your trade, your scalp, the best chance of success and the best chance of having a high risk reward. And what that means is that we basically don't have to risk that much money necessarily for great reward. We might risk $100 and maybe we'll have a payoff of 3 or 4 to 1. So if we made $400, we don't have to be right that often. It does give us less opportunities. We don't trade 500 times in a night doing this type of thing. But what we do is we have confidence in our overall analysis, and it actually makes you better at all types of styles. So I think in 2021, that's going to be very important, because whether you would like to think about it or not, there is a lot of algorithmic trading on the smaller timeframes as well. If we're on a 5-minute, 1-minute chart, there are huge amounts of robots trading in these smaller timeframes. Moves this year have been faster than ever before. When moves are so fast, it becomes very difficult for us to scalp them without considering the higher timeframes. So I think that's definitely something that people overlook.
Yeah, I'm just going to answer a couple of very quick questions because I think they're probably relevant to what we're talking about. The first one actually is just the moving averages. The red one is a 20 EMA, the 50 is a blue EMA, and the green one is a 200 SMA. Okay, so they're the moving averages that we use to answer that question. Now, the other question I've got here is about where you put your stop losses for scalping. Now, look, that's a really good question because a lot of people are fixated on just setting their stop loss on a dollar value risk or a certain amount of pips risk. With scalping, it's probably never more important than actually having your stop loss in the right place. So the simple answer to that question is probably not a simple answer in the sense that every stop loss is going to be different. I'm not going to say it's going to be 10 pips or it's going to be $100, whatever it is that you're setting your mind on. It's actually about price action. Price action and price waves are the most important things when you're setting your stop loss, okay? So when you're looking at, say, a moving average, the little simple scalping we looked at before, where you're buying the 50 moving average or you're buying the 20 moving average when it comes back in a long trend, your stop loss needs to go behind the last swing. It always needs to be protected by price action. So if you go with a fixed stop loss, two things will happen. You're either going to be too aggressive on it and it's going to get stopped out, or you might go the other way and think you're giving it more room. You're giving it more room to move, so you make it bigger, but then you're kind of detracting from your risk reward because your reward might not be as good as the risk that you're applying on that trade. Okay, so they're very, very market adaptive stop losses, but the general rule of thumb is they should be at least behind the last swing. Okay, so the last trough or the last peak in a downtrend is where you want to have your stop loss, because that way it's market adaptive and you're giving it its best chance of survival and still getting a good risk reward ratio relative to the size that you're actually trading.
Yeah, absolutely, Ty. It's very important that you have dynamic stop losses and dynamic movements in anything really you do in the markets. So role reversal is another one that I think is often underutilized by scalpers. The concept that this could be any time frame. This could be a 5-minute, this could be a 1 hour, it could be a 1 minute. If you have multiple touches of resistance, and I always like to use the rule of thumb, if we have 3 touches of a resistance, that resistance is then broken and then it has found support. And I don't care if it's a 5-minute or whatever time frame it is. When it comes down and tests that zone again, because of the nature of that resistance or that support being 3 touches, it's going to be a better level for you to target. It's going to give you that higher statistical chance, most likely and hopefully, with the proper other analysis, to be correct. So again, those 3 to 4 reasons. One of those could be that we're following the uptrend here. We've also got the support and the resistance being the second one, and we're most likely also going to have some kind of moving average throughout somewhere here, maybe a 20 or a 50 or whatever that might be, following and acting as dynamic support as well. What about Fibonacci, like we just saw? All of these things you break down, you bring into your system. Maybe you have some favorite indicators, some oversold, something like stochastic or some RSI that's gone under a level that you like. All of these types of things you can bring in together. So we talk about don't FOMO. 2021 is going to be don't FOMO again. You're going to hear about riches and terrible and things that have happened to friends that have done well and this and that, just like we did back in the cryptocurrency times back in 17 and even recently. Please always remember that you worked hard for your money and you worked hard to save it. Don't give it away by making rash decisions, and try to treat your trading like a business. That's going to be the standard thing that we say every year. 2021, 2022, 2023. If you're a part-time trader, you want to turn yourself into a full-time trader. To do that, we cannot be FOMOers, can we, Ty?
Absolutely. Look, for those of you, I know a lot of you out there already come to our weekly webinars that we run every Wednesday night, and I know a lot of you part of the trading community group. So you're well attuned to hearing us repeat that over and over again, and that's because it's so important. Okay, so it's really, really important to remember that, because it's one of the golden rules of being successful at the trading game. I'm going to answer another very quick question, just so everyone can benefit from it. We've got a question asking why we use a simple moving average on the largest time frame, the 200, and we use exponential moving averages on the smaller ones. So the answer to that is, the bigger the big time frame, the 200 moving average. The thing with a simple moving average, which is the SMA, is that it's an absolute average of that period. Okay, so if you've got a 200 moving average, you're basically getting an average of the last 200 candles, whatever that may be. If it's a 15-minute chart, it's going to be the last 200 15-minute candles. If it's a daily chart, it's going to be the last 200 days, which is obviously getting very close to half a year. Now, exponential moving averages, they give more weight and allocate more weight to the front end of the candle. So if you were looking at a 20 moving average, there's going to be more weight to the movement of the last few candles as there is at candles, say 16, 17, 18, and 19, and 20. So it doesn't really make sense to have an EMA on a 200 because it's giving way too much weight to the front end, but there's such a big long back end that is really not being accounted for. So it's easy to keep that as an SMA, and it is one of the most popular in the world. Okay, so the 20 and the 50, we need to be more dynamic, we need to be more price reactive. That's why they're EMAs. But the 200 is more a really dynamic stop resistance and support zone that we can look back in time. We don't want that to be weighted to the front. We want to see the actual average of the 200. Okay, so hopefully that answers that question for you.
So Tyrone, I'd like to actually hand it over to the community to ask some questions. So post some questions through. We've got some more segments coming through right now, but ask questions now if you have them for 2021 or anything to do with this year, or any just questions that you've got to ask or you want to ask about scalping, day trading, or swing trading. Ask them now so that we can answer them, because we'd love to hear from you, obviously, in this final webinar of the year that we're doing. But I think that with scalping or with day trading or with anything to do with the swing trading in general, one of the ways that I've always approached it is keep it simple, stupid. Okay, so KISS principle. And I was taught the KISS principle a long time ago, and I think it's really, really smart. And that is that you have often probably seen people present technical analysis to you. And that technical analysis might look something like this. We go to a chart, we look at a 4-hour, and they have lines everywhere. We've got trend lines, we've got a line coming through here, we've got a line going through there, and you basically draw curve fitting lines and all sorts of things. So many indicators that you can't see the actual price action. The most important thing in the price is the price. When you're trading, the price is the most important. That's the psychology of the market. Every indicator that you add to the chart, it's interpreting the price action. It's generally a lagging indicator. It generally reads what the price is doing and then presents that in a very understandable fashion that you can use that, whether it be stochastic, whether it be MACD, whatever it might be. So I would say that one of the things that I would go into 2021 doing is, if you're somebody that can't see your price action because there's so many indicators on there, try to think about the keep it simple or KISS principle, KISS principle reasons, because that's something that really, I think, changed Tyrone and I's trading when we went to what they call like basically blank charts. And we would start with a blank chart. We would read the chart. We would find the reasons that we're interested in being in the trade, and then we would add to it with our other knowledge. We'd add our moving averages, we'd add our VWAP or whatever else indicator we might be using, possibly MACD, whatever it might be, and see whether they agree with our initial process. So think about doing that one.
Okay, all right, so we've coming through here.
Yeah, what have we got? A few questions. Wow.
Okay. Tarquin wants us to draw some Fibos.
Okay, so I think what Tarquin's probably saying is, if we're drawing Fibonacci's that is, how do we draw them? Do we draw them between wicks or do we draw them between bodies? It's a question we get asked quite a lot. So say here, if you were taking this pullback to the top, we would draw wick to wick, and we generally tend to draw wick to wick. The reason why is because there's no subjectivity to it. If you draw wick to wick, on some time frame, remember there is a body. There is most likely going to be a body somewhere around here. Not always, because of course, but on a minute or something, there's probably going to be a body in most of these areas. So we generally go all the way from the wick to the wick, just because we find that the easiest. Now, which are our favorite Fibonacci levels, Tarquin? 38, 2, and 50. If you were to go with what we like and what we like to see in a healthy trend, Tyrone mentioned the 2 steps forward, 1 step back. The 1 step back should take us no greater than 50. And I know everyone's going to say, whoa, Tom, 61.8, the golden fib. We need to use the golden ratio. Yes, but the problem is that when a market comes back too much, often what will occur is it loses, there's faith lost in this particular trend, and it starts to actually reverse. So we've found 38.2 and 50 fib in this range here is a great box range. Remember, we mentioned box range before to potentially find opportunity. It's a good question there, Tarquin. Thank you.
Most definitely. I've also got a question here asking about how much weight we give to each of the indicators, including MACD, stochastic, and moving averages. That's a really good question from Alistair, actually. And look, I'll give it a very quick answer. In terms of indicators, Alistair, it's most important to use indicators that, one, you totally understand, because then you understand what the signal is actually trying to tell you, but also use ones that actually giving you different information to each other, okay? And that's probably the most important part. One is not really necessarily more important than the other and isn't given more weight than the other. It's all about where it is in terms of where a chart is, okay? So for instance, to give you an example, a moving average is a really good indicator to use in a trend. Okay, so moving averages, when the market is trending, fantastic. It gives you the entry point on the pullbacks. It's dynamic. It's really good. In a sideways moving market, not so helpful. Now, the opposite of that is a stochastic indicator, where in a sideways moving market, the stochastics is fantastic. But in a trending market, you really have to adjust the way you use it to actually benefit from its signal. So they're both really important, but they're really important in the type of market that you're trading. So it's really important to understand the market you're trading, and also understanding what the indicators actually are telling you, so you can ascertain whether that information is important or not. So it's not that the one's more important than the other. It's more that they're important at different times of the market cycle. Okay.
Warwick says, learn the language of the candles. Absolutely, Warwick. And we've got another really big word of wisdom here from Amanda. It says, trade what price tells you and not what anyone else thinks. Yes, I couldn't have put it better myself, Amanda. Unfortunately, many people get caught up with what their friends think, or what the Bloomberg says, or whatever any newspaper says, or even articles, and they let that cloud their judgment from what the pure trend and the price action is telling you. We've got some other questions here. Mark's asking, we've not mentioned volume. So we definitely do use volume, Mark. It just depends on the type of instrument that we're trading at the time. So for currency, volume is good, but volume is maybe not as good as it is for if you're trading a stock like in the markets like Tesla or Apple with Pepperstone. That would be where you would maybe use volume a little bit more. It shows you accumulation, it can show you breakouts, it can show you hidden reasons to be in the trade, all sorts of things like that. So I think that there is a place for it, but it just depends on the instrument that you're looking at. A few questions about gold as well. Look, gold and silver, they continue to be very interesting pairs in 2021. If you went with what happened out of the recession in the GFC, both had fairly strong couple of years, and then that was paired by a pretty bad kind of decade really of investment in those minerals and those metals. So I think that the thing is with gold and silver is that there will clearly be a trend that begins in 2021, and it will generally go for, usually with gold, a substantial period of time. When a trend starts, it continues for potentially multi-years, and we're already in a pretty big bull trend at the moment, really.
Definitely. Doreen asks, can she do away with indicators when scalping, or are they actually useful? That is, it's an interesting question. Look, nothing is more important than price action and support and resistance when it comes to scalping, Doreen. There's no question about that, but it doesn't mean that indicators don't have their place. And again, it really comes down to the market that you're trading. If you're scalping in the direction of a trend, moving averages are paramount to actually really good entries. And if you're using stochastics, overbought and oversold levels in a sideways market to scalp, they're equally as important. So it really comes down to the market environment that you're trading. I wouldn't suggest to do away with them, but I would suggest not to highly use them as your only reason for entry. They are secondary to price action and support and resistance always. Okay, so never just use indicators as a reason to scalp, but use them as supplementary information to verify what you're seeing in the other part of trading, which is the price action and support and resistance. When you use them as what they are actually there to do, which is indicate what may happen, they are far more powerful.
Okay, Ty, well, I think it might be best to just quickly go through this and I'll answer another question or two before we finish up. So we obviously are in the Christmas cheer a little bit here. Everyone's had a very interesting year, I'm sure. And look, we are doing a Christmas special. If you're interested in finding out more about technical analysis masterclass, that includes our normal kind of 5-module series that we've created over a very long period of time. We've got an advanced course in there as well. So it takes you from beginner to intermediate to advanced. And it also at the moment comes with 3 months access to our private trading chat room, a trading competition, which is going up to $20,000 every month in terms of the month and how much we're trading. So it's a pretty substantial abilities for you to not only show your technical analysis skills with the community and share it with them, but also to potentially win some of the money that is made in that account. So with that, I think that's a great initiative that we've done. And of course, it's learn at your own pace. So what better time to potentially get into it over the Christmas holidays, tie into the new year? I think it's going to be a good time to get started with that type of stuff. Yes, this webinar will be saved and it will be on the YouTube channel, being Pepperstone's one. We encourage you go to YouTube, type in Pepperstone, and of course, subscribe to that. If you've got time as well, you can come check out us at FX Evolution. And we had a question here, I think, from Andile. I may be wrong here, or Andil. It says, how do we let our winners run if TP hasn't been hit? So basically, I think maybe you're saying if the TP has been hit. So if you get a TP hit, possibly one of the things that you can try in a demo account next to your real account is maybe you take your take profit like you usually would. But what you could do in a demo account, one of the best things you can do with Pepperstone demo accounts is you could maybe take 2/3 of the order off and leave a third on to your next technical take profit. See which one works out over a 3-month period. Then you can see whether it's worthwhile doing. That's how we've scaled in a lot of our stuff over the years. So Tyrone, I think from both of us from FX Evolution, we wish everyone a very Merry Christmas. We wish everyone, of course, a Happy New Year. We really hope you've enjoyed Pepperstone's offering this year of great webinars from us and everybody else. And I think, Tyrone, look, I can only say that I'm really looking forward to 2021, and I'm sure you are as well.
I am. I think it's going to be a really, really big year. I know Pepperstone have got some amazing things planned for everybody. There's going to be very, very big changes and developments that are going to really benefit everybody in 2021. So be sure to check out the webinars that come to you thick and fast every fortnight. Now, there is a survey that Pepperstone run after this webinar. If you could take a minute of your time just to answer the questions, it just helps everybody create the best content for you, the most relevant content, and really bring to you what you want to hear and what's going to be most beneficial. Over the holiday period, if you haven't seen any or many of our webinars, be sure to check out the Pepperstone library and go right through, and they're all well headlined, so you'll be able to really decipher which webinar you would want to see. There's a lot of really good information there. It's never taken down, so it's on the channel. You can scroll through and see what is actually there for you and what could be beneficial, and check out the replays because they can be very, very good learning tools to help you really get yourself ready for 2021. Now, we have had a lot of questions tonight about the about pairs that you wanted to have a look at. If you want to do that, certainly check out our webinar that we're starting in about 10 minutes. We do that every Wednesday night. It's a live market analysis webinar. We talk about very similar things to what we did tonight, except we're looking at it in the live markets and looking for trading opportunities. So I'll post that link in the page. Now, it's free to attend. Just click on the link and you can register for free, and then we will be able to see you there. But look, thank you on behalf of both of us and Pepperstone. Thank you so much for joining us throughout this week and also throughout 2020. We hope it's been really, really good for you, and we hope you have a fantastic 2021.
Absolutely, we certainly do, Ty. It can only get better. It can only get better. All right, thanks very much from all of us. See you in the new year. Bye for now.